Hello and welcome. A very warm welcome to everyone who's joining us today for another installment of our wealth planning webinar series. My name is Ryan Walker, hosting you today out of Camas, Washington. I'm a senior wealth manager with Stansberry Asset Management, and I'm also a certified financial planner and certified exit planning advisor, helping individuals, families, and business owners make smart decisions about their wealth so that they can protect what they have built and enjoy the life that they are working hard for. Today's session is called Make the Most of 2025. We are going to walk through a curated list that you can use to reduce taxes, avoid costly mistakes, and enter the new year confident that your wealth is working effectively for you and for your family. This is information that applies whether you're already retired, still building toward retirement, or even running a business. There are several important deadlines that come at the end of the year, and by being proactive, we can take advantage of opportunities that disappear once December 31st passes. As a reminder, all of our prior webinars are archived on our website and can be viewed at any time by going to stansberryam.com, navigating to the Insights tab, and click on Demand Webinars. My goal for today is to keep this simple, focus on what matters most, and give you a few steps that can have a real impact. So with that, let's move ahead. Here is what I plan to cover today. First, we'll talk about why year-end planning matters. A lot of financial decisions are flexible throughout most of the year, but there are some very valuable opportunities that disappear after December 31st. We want to make sure that you don't miss the ones that apply to you. Secondly, we know everyone is busy, especially around this time of year, and it's not realistic to tackle everything at once. That is why we narrowed down this to a short list of priorities that are most worth your time to investigate further and in more detail. These are the moves that can lower taxes, simplify your financial life, and give you more control over next year's income and investments. And finally, if you stay with us through the end of the session, we will have a very helpful gift that we'll be providing. It's a practical resource that makes it easy to take what you learned today and put it into action. And you're also welcome to share it with family or friends, anyone else who you think might benefit from this as well. So with that, let's jump right in. So why do we talk about year-end planning at all? The main reason is that the financial calendar does not run on our personal schedule. There are certain decisions that are tied to December 31st. If we wait until January, some of the best opportunities expire and we lose the ability to make those changes that could have saved us money or improved the long-term viability of your financial plan. Year-end is also a chance to clean things up. We can deal with any loose ends, make sure that we're taking advantage of the tools available to us, and start the new year organized and confident that we haven't missed anything important. So let's hop right into the key benefits. When we take the time to look at your plan before the year ends, there are 4 big benefits that can make a real difference. First, we can find tax reduction opportunities. There are only a handful of ways to lower taxes after the year is over, so this window gives us the chance to act while we still can. Second, we make sure that you're maximizing retirement contributions and other savings opportunities. Those dollars grow tax advantaged for the rest of our lives, but only if they are contributed by the deadline, December 31st. Third, year-end planning protects your wealth. We can confirm that insurance, investments, and risk management are supporting the goals that you care most about. And finally, it's a chance to keep family and legacy planning, estate items, totally up to date. Life does change quickly. Making sure documents and beneficiary designations are current helps us avoid unnecessary stress later on. So these are the real payoffs: lower taxes, stronger savings, better protection, and a clearer plan toward heading into the new year. So now that we've covered why year-end matters, let's make this simple. The guide we put together as a complement to this webinar will get into much greater detail. Here, we've narrowed it down to the top priorities that we think truly move the needle. These are the areas where just a little attention can lead to a real savings, better protection, and a smoother start to the new year. So let's walk through the top 5 areas we're focusing on today together. First, we're going to cover retirement and savings deadlines. Maximizing your employer retirement plan contributions, such as 401k, 403b, 457s, confirming required minimum distribution options, and reviewing HSA contribution opportunities. These are essential because once the calendar flips, many of these tax-advantaged opportunities are gone. Let's begin with contributions to your retirement plan. For example, a 401k, 403b, or another similar employer plan. For most plans, salary deferrals and employer contributions must be completed by December 31st of the calendar year. Contributing now reduces current year taxable income, if you're using pre-tax contributions, of course, and feeds more tax-deferred growth. If you expect year-end bonus income or other compensation, you do need to evaluate whether increasing your contribution rate before the year end might make sense. But be mindful, front-loading contributions too early in the year may cause you to miss the employer match later in the year. Also, if your plan allows it, you may be able to make after-tax contributions to your employer plan exceeding the regular pre-tax or Roth contribution limits. You should also consider whether a Roth option or a pre-tax option is best for your tax situation going forward. Finally, if you are over age 50 and considered highly compensated by making more than $145,000 per year, there are some changes that are going into effect in 2026 that may have a significant impact on your ability to make pre-tax catch-up contributions. You should be aware of these changes, which are outlined in the resource we'll tell you more about at the end. Next, we move to required minimum distributions, or RMDs. If you are at or beyond the age threshold, currently age 73 or older in most cases, you must take the RMD for this year by December 31st. If you don't, you may face significant penalties and unexpected tax bills. If it's your first RMD this year, you may technically have the option to delay until April 1st of the following year, but that does mean that you have 2 RMDs in one tax year, which could push you up into a much higher tax bracket and reduce some of your tax flexibility. If you hold multiple IRAs or different types of employer plans, you will need to coordinate which accounts you need to take from because the rules do vary by plan. If you don't need the money for spending and have charitable inclinations, you should talk to your wealth manager about making a qualified charitable distribution in order to maximize the impact of your generosity. Note that Roth IRAs are exempt from lifetime RMDs, and some employer plans allow you to delay if you're still working and not more than a 5% owner. You should use the RMD event as an opportunity to revisit whether your retirement income, your tax bracket, and your portfolio allocation are still aligned. Finally, let's cover health savings accounts, or HSAs. If you're eligible, you do have to have a qualifying high deductible health plan and no disqualifying coverage, of course. HSAs are often called the triple tax benefit vehicle. Contributions are tax deductible, growth is tax deferred, and qualified withdrawals are tax-free if used for qualified medical expenses. While HSA contributions for a given year typically can be made up to the tax filing deadline in April, many advisors treat the end of the year as a practical deadline to plan. Do review your eligibility. When you have a single versus family coverage, that does matter. Whether you're age 55 or older, that matters as well because there's a catch-up contribution. And whether you expect to pay medical expenses out of pocket now rather than dip into HSA funds. Treating the HSA as a long-term retirement savings tool by paying medical bills out of pocket now if you can and invest the HSA funds for the future could be considered a smart strategy. But you must watch out for exceptions. If you lose eligibility mid-year or roll over your coverage, pro rata rules can apply. Also, non-qualified withdrawals before age 65 can face taxes and penalties. You may wonder, did the One Big Beautiful Bill change these deadlines or move these rules around in any way? The answer is that it did not alter the mandatory deadlines for retirement plan contributions, RMD timing, or HSA eligibility rules. That said, the legislation did introduce some other tax changes. For example, the new $6,000 senior deduction if you're over the age 65 and eligible, but not an alteration to the core deadlines that we're focusing on today. Business owners should also confirm retirement plan design choices now for CEP, solo 401k, or cash balance plans, even if final funding happens later on. In summary, the year-end lock-in window for most powerful retirement and savings moves is December 31st. Contribute to your plan now, satisfy any RMD requirement, and leverage your HSA contributions, all while considering your broader income, your tax situation, and legacy situation. Now we will look at some of the practical steps you can take before the year ends to help reduce taxes and improve long-term after-tax returns. These items do require action while the year is still open. The first item is tax loss harvesting. Tax loss harvesting is performed by SAM throughout the year by our investment committee until around mid-November. After that time, you and your wealth manager should discuss whether any additional loss harvesting opportunities may exist for you. If you have investments that are temporarily down in value, selling them before the end of the year can allow you to use those realized losses to offset gains or reduce up to $3,000 of ordinary income. You can temporarily hold the proceeds in cash or immediately reinvest the proceeds in a similar but not identical investment, which keeps your portfolio fully invested. You need to be mindful of the wash sale rule, which prevents you from claiming the loss if you buy back the stock or a substantially identical investment within a 61-day window. That is 30 days before the sale, the date of the sale, and 30 days after the sale. The second item is reviewing last year's return, tax return, that is. This is one of the best planning tools that we have because it shows us what drove your tax bill, whether there were any surprises, and which deductions or credits you actually used. It can help you project where your 2025 income and deductions might land. With the One Big Beautiful Bill Act that was passed this year, there are some newer opportunities and updates that made changes to the tax landscape, including expanded deductions for older taxpayers and changes to itemized deductions such as SALT. Reviewing the prior return now, it can help you understand if you have been underpaying or overpaying your estimated taxes in 2025, and also helps you not miss out on any opportunities to help mitigate taxes in 2025. This extra step can also remind you about staying on track if you need to make estimated tax payments throughout the year to avoid underpayment penalties. The third item is evaluating a Roth conversion. This means voluntarily moving pre-tax retirement money in a traditional IRA into a Roth IRA and paying the taxes on that money today so that the future growth and withdrawals in the Roth can be tax-free. This can make sense if your current tax bracket happens to be lower than what you might expect it to be in the future, or if you want to reduce your required minimum distributions later on in life. If you have unfortunately lost a spouse this year, you may be able to still file married filing jointly in 2025 and then move to a single filer in 2026 next year, which would be less advantageous from a tax perspective. There could be an opportunity to perform a Roth conversion in this scenario as well. Roth IRAs also provide much more flexibility for beneficiaries. However, a conversion can push you up into a higher federal tax bracket, Medicare premium bracket, or phase out from certain deductions and credits. We can help you actually run the numbers to compare the cost today versus the benefit tomorrow. The one big beautiful bill extended current tax brackets, which means that there is still a meaningful window to convert at potentially attractive rates. If you wish to complete a Roth conversion in 2025, please let your wealth manager know as soon as possible or by early December at the latest to be sure that we have enough time to complete your request. In short, smart tax and investment planning at year end is about finding opportunities that keep more of your returns working for you, harvesting losses carefully, learning from last year's return, and weighing the benefits of a Roth conversion are some of the most valuable steps you can take right now. We will look at each client's situation individually, run projections, and make sure any changes fit with their long-term financial plan. Next, we want to discuss insurance and risk protection. This is the part of the plan that does not feel urgent until something goes wrong. Year end is the right time to make sure that the safety net is sized correctly for your needs. Start with your life insurance. Consider whether your coverage still reflects your current income, your family's overall needs, and your financial responsibilities. If you have a term life policy, check how many years remain and whether converting part of it to a permanent coverage policy might make sense. If anyone depends on your future earnings, they should be covered in your plan as a beneficiary. Health insurance is the next key item. The open enrollment window for Medicare is October 15th through December 7th. During this window, beneficiaries can do things like enroll in or switch Part D prescription drug plans, switch from original Medicare to a Medicare Advantage plan, otherwise known as Part C. You could switch to another Medicare Advantage plan, or drop Medicare Advantage and return to original Medicare, possibly add a Part D plan in some cases. Open enrollment is when many people can make changes to employer or marketplace plans as well. Remember that letting last year's choices just simply roll over and match your coverage to your expected medical needs for next year might be a better opportunity. Anyone near Medicare age should also review their plan details and drug coverage, since out-of-pocket costs can vary quite widely. During open enrollment, also check for employer benefits that offer legal services. Some legal plans cover estate planning at a significantly reduced cost. If you do not have a will or other key documents in place, like a power of attorney, healthcare directives, etc., enrolling in this type of benefit for just a year might be an affordable way for you to complete or update your financial plan. Now for business owners. You should also review business-related insurance coverage. This may include key person insurance, disability for the owner, and business overhead protection. If something happens to you or to a critical employee, the business still needs to operate. Also, take a fresh look at any buy-sell agreements, and if the value of your business has changed or your debt has increased, the insurance funding that supports the agreement may also need to be updated. If you need help evaluating insurance coverage for your business, please reach out to your wealth manager for a referral to someone who we think can help you. The One Big Beautiful Bill Act brought changes to how some employer benefits can be structured. For business owners selecting benefits, it can be a good time to evaluate whether new options might provide with better tax treatment, stronger protection for both you and your team. The key takeaway here is pretty simple. Investment growth is important, but unmanaged risk can undo years of financial progress if there's a catastrophic event. Reviewing these policies now protects both your household finances and, for business owners, the business that supports them. Let's turn our attention to estate and wealth transfer planning. We'll focus on two high-impact areas before the year end. Reviewing and updating your estate planning documents, and considering whether gifting or any charitable strategies might make sense for you this year. These steps matter because a strong estate plan protects your family, preserves your legacy, and can reduce taxes and complexity after you're gone. First, review your estate planning documents. Ask whether your will, your durable power of attorney, your healthcare proxy, trust documents, and beneficiary designations remain aligned with your current goals. Check your account registrations and how your home is deeded and your vehicles are titled. Ask yourself if there's been changes to your family, such as a marriage, a divorce, births, deaths, or blended situations. Have your assets changed significantly, perhaps through business growth, real estate acquisitions, or investment gains? For business owners, also check that your succession plan is up to date, and that any ownership or buy-sell agreements reflect current values and current partners. Next, let's talk about charitable and gifting strategies. If you have the financial capacity, using gifts to children or grandchildren or supporting charities this year can help shift assets out of your personal estate while you're alive and may reduce future estate taxation or the death tax. With the OBBB legislation, some tax rules and deduction limits may have changed. For example, older taxpayers may qualify for new deductions, and itemized deduction rules may shift in 2026. These changes may alter the ideal timing or gifting of strategy moves. For instance, if your taxable income is unusually high this year, making a larger charitable gift now may be more advantageous than waiting and doing it over multiple years. There are different ways to be charitable, and your wealth manager can walk you through your options in much greater detail. Additionally, if your business has had a strong year and you expect future growth, you may want to accelerate gifts while valuations are favorable. It's important to balance the plan with your cash flow, your tax bracket, and your long-term goals. Gifting too heavily without reserves can hurt your ability to invest or cover your own interests and risks. Charitable strategies often require consistent giving and planning and should be part of your broader wealth financial plan, not just a year-end tax move. One special consideration for business owners: if you own shares in a closely held business, You should check whether your transfer or succession plan supports gifting or transferring business interests to a family member or to a trust. If you expect the business to grow or may have an opportune moment in the future to remove value from your own personal estate, this could allow you to do so at a much lower cost. But you'll want to make sure that the transfer is well documented by a business attorney and that the business remains properly capitalized and well managed, of course. In summary, estate and wealth transfer planning is not just for the ultra-rich. It's a fundamental part of preserving your legacy and giving your family or business the best support long after you're gone. By reviewing documents and considering gifting or charitable strategies now, especially in a year when the tax law, because of the OBBB, has shifted, you will ensure that you remain in control and you don't leave planning just to chance. The last piece of our year-end review focuses on lifestyle and future planning. These are parts of life that make money meaningful. As we look ahead to next year, think about any planned changes that might affect your finances. This could include buying or selling a home, moving, planning a major renovation, or taking a milestone trip. Reviewing these plans now help make sure that your cash flow is there when you need it, without disrupting your long-term goals. Depending on how your accounts are structured, taxable accounts, tax deferred, or tax-free Roth IRAs, it may make sense to take a larger planned distribution over 2 or more separate tax years to smooth out the tax impact of what your marginal tax rate will be. The second item here is account consolidation. Over time, many clients collect multiple accounts held at many different institutions. And while it might seem harmless, having accounts scattered all around can lead to missing statements, poor coordination, and an unclear big picture of risk and allocation. If you do have accounts outside of SAM that you are considering bringing under our management, this is a great time to talk about what that might look like. Considering consolidation can simplify your life and improve the quality of SAM's ongoing advice in the future. If you're a current client and have other financial accounts elsewhere and you're considering consolidating, please reach out to your wealth manager and we'll make the transfer process as seamless and easy as it possibly can be. The goal is to go into the new year with a clean and organized financial picture so that you can focus on enjoying your life while we help you handle all of the details. The next slide here highlights Sam's gift to you. I do want to thank you for joining and staying with us through the end. As promised, we put together a valuable resource as a gift to help you take the next steps and learn more detail about the topics discussed in today's presentation. This guide covers the most important year-end planning actions for 2025. It includes a quick checklist, deadlines to remember, and conversation starters between you and your wealth manager, your tax professional, or your attorney. You can use it for yourself, and you are welcome to share it with family or with friends who would benefit from these reminders too. If you're watching live now, and you know someone in your life who would like access to this guide, just type in the word referral into the chat. We'll follow up with you afterwards to make sure that they receive a copy of this at no cost. This is our way of helping you extend the benefit of today's conversation to the people that you care most about. If you are not currently a client of SAM, but you're interested in learning more about us, I encourage you to please reach out. You can call us at 646-854-2995, email us at info@stansberryam.com, or visit our website at stansberryam.com. Scan the QR code shown here on the screen if you'd like to schedule an introductory meeting with us. And also please follow us on social media, where we post frequently different investment and planning related ideas and topics. We'd love to have you join our online community on either LinkedIn, Facebook, or on X. Lastly, this presentation is intended to be for informational purposes only and should not be construed as tax, legal, or personalized investment advice. For tax recommendations, you should contact your CPA. For legal concerns, you should involve your attorney. We can collaborate with your entire team to be sure we're all on the same page. Thank you again for joining us today for today's webinar, and I hope you enjoy the rest of your day. See you next time.